Is the banking industry on the brink of a crisis? This question has been looming in the air since the downfall of 3 regional lenders last March. This event was not an isolated incident. It sent shockwaves through the industry, leaving hundreds of smaller banks in a vulnerable state. These banks, once robust, are now wounded and struggling to regain their footing. The lifeline that could potentially save these banks from sinking is merger activity. But here's the catch: this activity has slowed to a trickle. The once bustling merger market has turned into a quiet street, with fewer and fewer banks engaging in this crucial activity. It's a bit like watching a suspenseful movie, where the hero is in a perilous situation and the audience is left wondering, what's going to happen next? The banking industry is seemingly in limbo, but where might the next cracks appear? How does commercial real estate exposure play into the current predicament of these banks, you might ask? Well, let's take a closer look. The Claros Group, a leading financial research firm, analyzed a whopping 4,000 financial institutions. Of these, a not-so-insignificant 282 were found to have high levels of exposure to commercial real estate. And here's the kicker: these same institutions also had large unrealized losses due to the surge in interest rates. Now, for the uninitiated, commercial real estate exposure can be a double-edged sword. On one hand, it can provide banks with a steady stream of revenue, but on the other, it can expose them to significant risk, especially in volatile market conditions. In this case, the surge in rates has hit these banks hard, leading to these large unrealized losses. But what does this all mean? In simple terms, these banks have a lot of money tied up in commercial real estate, and with the rate surge, the value of these investments has declined. The losses remain unrealized because the banks haven't sold these investments off. But the potential for loss is very real. And this puts these banks in a precarious position. And the implications for the industry at large? Well, it's a bit of a domino effect. When a bank with high commercial real estate exposure faces financial challenges, it can lead to a ripple effect throughout the banking industry. Other banks may become more cautious in their lending, which can slow down economic activity. And if a bank were to fail, it could potentially lead to a financial crisis. So, what's next for these 282 banks? They're in quite a bind. They have limited options, either to raise fresh capital or merge with other banks. Raising fresh capital would mean convincing investors to put more money into the bank, despite its current challenges. On the other hand, merging with another bank could help to spread the risk, but it's not a guaranteed solution. These banks are now left with limited options, either to raise fresh capital or merge. This precarious situation certainly puts the spotlight on the critical role of commercial real estate exposure in the banking industry. What are regulators doing behind the scenes, you may ask? Well, it's quite an intriguing dance of power and persuasion. Based on insights from Claros Group co-founder Brian Graham, it seems regulators are not sitting on their hands. They're actively engaged in a behind-the-scenes balancing act, aimed at ensuring the stability of the banking sector. You see, regulators have been prodding banks with confidential orders. Yes, you heard it right, confidential orders. These are not public statements or broad advisories. They're specific, targeted instructions given to individual banks. And these orders have 2 main objectives: to improve capital levels and to enhance staffing. Let's break that down a bit. When we talk about improving capital levels, it means regulators are pushing banks to have more financial reserves. More capital essentially acts as a buffer against potential losses. It's like having a rainy day fund. If things go wrong, banks have something to fall back on. And in an industry still recovering from the shockwaves of last March, having that safety net is crucial. As banking professionals, what does this mean for you, I hear you ask? Well, let's delve into that. Given the current banking landscape, it's clear that the profession isn't immune to the tremors shaking the industry. With the potential mergers on the horizon, job roles and responsibilities may see a seismic shift. As institutions merge, redundancies become more likely, leading to potential job losses. A merger isn't just a blending of 2 companies, it's a blending of cultures, systems, and yes, positions. However, it's not all doom and gloom. While the uncertainty might seem daunting, it also opens up a world of possibilities. With change comes opportunity. The current landscape could necessitate banking professionals to adapt and acquire new skills to navigate these changes. This could mean learning about new technologies, understanding different regulatory environments, or even gaining expertise in areas previously unexplored. In some cases, the changes could be more profound. For instance, banking professionals might need to shift their focus from traditional banking roles to more specialized ones. They might need to become experts in risk management, regulatory compliance, or even data analysis. These aren't just buzzwords, they're the future of the industry. Also, the shift could lead to a more collaborative environment. As banks grapple with these challenges, they might need to work more closely with other sectors, such as technology or real estate. This could create a more interdisciplinary approach to banking, breaking down the silos that have traditionally defined the industry. In essence, banking professionals are on the cusp of a new era. This could be a time of great upheaval, yes, but it could also be a time of great opportunity. The key is to embrace the change, adapt, and grow. The banking industry is evolving, and so too must its professionals. Banking professionals are not just observers in this crisis, they too are directly affected. Let's remember though that with every challenge, there's an opportunity to learn, to adapt, and to rise above. So as we move forward, let's do so with a spirit of resilience and innovation. What does the future hold for the banking industry? This question has been on the minds of many, and while we can't predict with absolute certainty, we can discuss some potential scenarios. The first scenario to consider is further closures. The forces that led to the collapse of 3 regional banks last March have left hundreds of smaller banks wounded. With merger activity slowing to a trickle, many of these institutions may not be able to survive. The second scenario is an increase in mergers. While merger activity has slowed, it hasn't stopped completely. Many banks, faced with the need to raise fresh capital or risk closure, may choose to merge with larger, more stable institutions. This could lead to a consolidation of the banking industry, with fewer but larger banks dominating the landscape. The third scenario involves a greater need for fresh capital. Banks with high levels of commercial real estate exposure and large unrealized losses may be forced to raise fresh capital to stay afloat. This could mean seeking investments, selling assets, or even issuing new shares. But perhaps the most likely scenario is a new norm for the banking industry. Regulators have been quietly urging banks to improve their capital levels and staffing. This suggests a future where more stringent regulations are the norm. Banks may be required to hold more capital, employ more staff, and place a greater emphasis on risk management. This new norm could lead to a more resilient banking industry, but it could also mean higher costs for banks, which could be passed on to customers in the form of higher fees or interest rates. And it could mean a less competitive industry, with fewer banks able to meet the new requirements. In conclusion, the future of the banking industry is uncertain. We may see further closures, more mergers, a greater need for fresh capital, and a new norm of stricter regulations and risk management. But one thing is clear: change is on the horizon. The future of the banking industry is uncertain, but change seems inevitable. The banking industry stands at a crossroads. Hundreds of smaller banks, wounded by the same forces that consumed 3 regional lenders last March, are in a precarious position. With merger activity slowing down, these institutions are left without a crucial lifeline. Furthermore, commercial real estate exposure has become a pressing issue, with 282 institutions found to be at high risk. The situation is further complicated by large unrealized losses from the rate surge, potentially pushing these lenders to raise fresh capital or merge. Behind the scenes, regulators are stepping in, issuing confidential orders to improve capital levels and staffing. This puts an additional pressure on banking professionals, who are now tasked with navigating these turbulent waters. As we look towards the future, it's clear that the industry is in for a shakeup. In the face of these challenges, the banking industry must adapt or risk becoming a relic of the past.